Many traders are currently watching the macroeconomy and positioning for a massive crash, only to watch Bitcoin spike and liquidate their accounts. We are observing a market structure where price consistently gravitates toward concentrated areas of short seller liquidity, functioning with the cold efficiency of a mechanical trap. This cycle is driven by a specific interaction. Retail traders open shorts at resistance. The price is pushed higher to trigger those liquidations, and market makers absorb the resulting capital to fuel the next leg. Right now, a technical warning signal is flashing on the 4-hour charts that suggests exactly when this liquidity hunt will reach its limit. Understanding the math behind this engineered move is the only way to avoid providing the exit liquidity that institutional players are hunting for. This liquidity heat map reveals dense, glowing clusters of short positions just above the current price. Below, funding rate bars drop into negative territory. Market makers push the price directly into this heaviest resistance to force a squeeze, offloading their own positions at a profit. Looking at the higher timeframes, the ultimate destination for this forced liquidity hunt is the macro resistance ceiling between $72,000 and $76,000. As long as these pockets of short liquidity remain uncleared on the heat map, the immediate trend remains biased toward this aggressive upward movement. While the price is moving up to hunt liquidity, the underlying momentum on the 4-hour charts is beginning to show signs of decay. This bearish divergence occurs when the asset's price continues to print higher highs, while the internal momentum oscillator, the RSI, makes lower highs. This specific signal suggests that despite the rising price, actual buying pressure is nearing exhaustion, and the move is becoming unsustainable. This isn't localized to Bitcoin. Ethereum is flashing similar lower highs, indicating a market-wide loss of momentum, even as breakouts appear to occur. The mechanical squeeze may continue for the moment, but the historical accuracy of this divergence suggests a significant pullback within the next 48 hours. Safely trading this type of environment requires a very specific risk management protocol to ensure you aren't caught on the wrong side of the eventual reversal. The first step is waiting for a confirmed 4-hour RSI rejection. You need to see that momentum peak and turn downward on a confirmed candle close before assuming the divergence is locked in. Step 2 is the placement of absolute tight stop losses. On a chart like Solana, for example, the $85 level is the pivot point. If the price closes back below that support, the bullish breakout is invalidated and you must exit the trade. Executing precise entries and exits requires a platform with high liquidity and low latency to minimize slippage. BingX is equipped to handle this level of volatility. Access the specific referral benefits linked below to get your account set up for these setups. Success in a liquidity hunt depends on following these technical steps with discipline, rather than trying to guess the market's next move based on emotion. In this market, the golden rule is to avoid fighting the trend until the RSI divergence actually forces a change in the market structure. While retail sentiment is braced for an immediate macro collapse, the data suggests we are instead witnessing a highly targeted short-term liquidation cycle. The short-term trend is the path of least resistance until the technical overhead holds and we see a confirmed breakdown on the indicators. Subscribe now to get daily tracking on these whale movements and the specific alerts we use to stay ahead of the next squeeze. This short-term play is only one piece of the puzzle. Click the next video to see the massive weekly supertrend that could completely redefine the macro outlook.